Are you worried that the stock market is going to take a nosedive, or that inflation is eating away at your savings? Or perhaps even that interest rates aren't going to reduce at the same rate that they were before? If so, then this video could be perfect for you. We're going to break down how bond funds, gilts, premium bonds, and money market funds perform in varied market conditions, so you can make smart decisions with your money and perhaps sleep better at night. But before we jump in, I wanted to remind you I'm not a financial advisor. I just share information that I use to help me decide my investment approach, and hope it helps with your decisions too. So when I think about the market, I think about the following levers that impact investing: interest rates, inflation, and the stock market performance. Now, of course, there's other factors like economic cycles, expansion and contraction, investor sentiment like fear and greed, and certainly our expectations around future economic conditions can drive the movements in the short term. And I think simplifying all this is quite useful. So I'm taking interest rates, inflation, and stock market performance as the three levers, and we'll consider those as part of our review of these assets. Now, each of these levers can go up or down, or stay relatively stable, or go sideways. Now, with this thinking, if we then consider all the different permutations, there's 27 different possible scenarios looking at these combinations. And that sounds complicated, but don't worry, I'm going to show the 9 most common scenarios, the ones that are most likely to happen in the market, and the usual impact of those scenarios on the assets, although there are sometimes changes to the market that mean they don't act as you would expect. And I've chosen these 9 scenarios as they're most relevant to a wide range of economic conditions, including inflationary conditions, deflationary conditions and periods, as well as bull and bear markets. They also give a good illustration of how the different assets that we're looking at perform under different circumstances. Now, like I say, this is not perfect. What it tries to do is draw out the changes that often drive the performance of those assets. But unfortunately, markets are markets, so therefore it's not always a simple straight line. For example, what happens when interest rates are rising, inflation is also rising, but the stock market is crashing? Or what if interest rates are dropping, inflation is cooling down also, but the stock market's shooting up? We'll explore these and other options. Now, which investments tend to shine in these sort of environments? Remember, we're not looking at equity investments, we're looking at bond type investments. So we'll focus on bond funds, gilts, premium bonds, index-linked gilts, and money market funds. Now, below in the description, there's a link to the file I'm going to share with you, and it shows the 9 more common scenarios at the top, and then below that you've got the 27 different scenarios and which asset investment types tend to perform better in those environments. At the top, you can see interest rates on the left, which shows increasing, decreasing, and stable. At the top, you've got inflation, increasing, decreasing, stable, and then different scenarios, including the performance of the stock market in each of the 9 boxes. Now, the ones highlighted in red are the ones I'm going to talk to, but the rest of the scenarios are available when you download the information. So let's take a look at the first scenario. Inflation is soaring, interest rates are being hiked to combat that inflation, and stock market is taking a real beating. So in this environment, the assets that have generally performed better historically are index-linked gilts and money market funds. You could also invest in premium bonds, because with interest rates going up, it's likely that the winnings on premium bonds will also increase. And these assets tend to perform better when there's economic uncertainty, or we're in a bear market, or the market's volatile. And with this, generally you'd be prioritizing capital preservation and liquidity over the higher returns. So take a look at another example. Interest rates are falling along with inflation, but the stock market is rising. Now, if you feel confident in equity investments at this time, then that's where you should probably invest at this point. But as this video is looking at bond cash type assets, then the sort of things you should look at is bond funds and possibly gilts in this environment. Like I said, there's many other common scenarios that we could consider. So feel free to download the table from the link in the description. It also includes a more comprehensive list of the assets and their specific characteristics, as well as the occasions or the scenarios when these investments are likely to perform better. So you can see the asset type or investment types on the left-hand side, and it talks through things like diversification, the risk associated with those particular investments, but also impact on those particular investments when the interest rates go up, when interest rates go down, the impact of inflation. One thing of note here, which I think would be quite interesting, is around the likely to perform better when. So this talks to when that particular type of investment is likely to perform better. So here, for instance, money market funds, they perform largely better when it's volatile or falling equity markets, and it is for allowing investors to prioritize capital preservation and liquidity over higher returns, for instance. So there's some examples where it draws out when those particular investment types perform better. So why don't we do a quick deep dive into each of the assets? I'll cover their main features, but also in what environment do they tend to perform better, and include the correlation that they have to equities and stock markets. I think this is important to understand when creating a balanced portfolio. It allows you then to better weather the storms of the market. So firstly, bond funds. Essentially, they're a basket of different bonds managed by investment companies. An example of this is the Global Bond Index Fund by Vanguard. It's well diversified, it's global, there's a very wide exposure to lots of different bonds and therefore diversifies the risks. Bond funds are generally quite liquid. On the downside, they can be impacted by interest rate changes. When rates go up, bonds typically go down in value. And they're also subject to inflation risk. Sometimes investors can see them as quite complex and therefore harder to understand. And they're normally subject to taxation on both capital gains and any interest or distributions. And of course, any dividends may also be taxed. And I wanted to cover correlation with the equity markets here as well. That's really important when it comes to balancing and having a diverse set of assets within a portfolio. So what is correlation? Well, let me draw it out through an analogy. Positive correlation, if you think about airline ticket sales and hotel bookings, generally, the more people that book airline tickets or flights also book hotels. And therefore, there is a correlation, positive correlation between the number of tickets sold and the number of hotel bookings. In the same theme, zero correlation would be when you consider ticket sales of the airline against perhaps garden supplies store. There's no likely meaningful correlation between the two, the sales of airline tickets and gardening supplies. They're independent of each other. So a negative correlation, so you can imagine the relationship between airline ticket sales and the price of gasoline. When gas prices soar, it often becomes more expensive to go on that journey. So the airline tickets become more expensive. And therefore, this will be a deterrent. Some people might decide to drive instead of fly, or even postpone their travel plans. So when gas prices go up, airline tickets are likely to go down, and that's a negative correlation. Perfect correlation is 1, and a perfect negative correlation is -1. Now, you'll often see this on a graph as 100% or -100%. And of course, a negative or low correlation can help smooth out a portfolio's returns over time by offsetting losses in one asset class with gains in another. Now, historically, the correlation between bond funds and the UK stock market has been quite dynamic, and it's been influenced by number of factors. And according to Vanguard, the correlation has generally been negative since the 1990s, meaning that when stock prices rise, bond prices tend to fall and vice versa. This negative correlation provides diversification, as bonds can act as a hedge against stock market downturns. But, and this is a big but, there have been periods when correlation has shifted. We saw this in 2022 when both equities and bonds experienced negative returns, and that indicated positive correlation. And it was driven by a sharp increase in interest rates. And this positive correlation was an exception to the long-term trend, and it reversed again in 2023, interestingly. So let's take a look at gilts. Gilts are bonds that are issued by the UK government. It makes them low risk. They're liquid, meaning you can buy and sell them relatively easily. A number of brokers offers that service. Hargreaves Lansdown is an example here on screen. They're generally seen as a safe haven during times of uncertainty. However, the potential for capital growth is limited when you compare it to equity investments. One of the major benefits of gilts is, although they're subject to tax on distributions, they're capital gains tax exempt. When we look at correlation between gilts and the equity markets, it tends to be positive. They move in the same direction. Both gilts and equities are affected by changes to interest rates. Correlation of annual returns over the last 124 years is around 0.46 or 46%. You can see the chart here on a rolling 10-year basis, which post the global financial crisis turned negative and hit a record low of 64% in 2012 and remained negative for 10 years thereafter. But currently the correlation is positive but low. More broadly, when we consider how this can be beneficial, so when we see a mix of equities and gilts, it has a lower volatility in the medium term, but interestingly, over the longer term, equity volatility levels out after 12 years. So it very much depends on the time horizon you're looking to invest and your risk tolerance during that period. Moving our attention to premium bonds. Now, I've created lots of videos around premium bonds. I've linked one above. They're a unique saving product offered by the UK government. You don't earn interest, but you're entered into a monthly prize draw for a chance to win tax-free cash. They're very safe. Your money's backed by the government. It's easy access, easy to understand, but they offer no guaranteed return and they don't protect you from inflation. The beauty, of course, is the winnings are tax-free. There's no real correlation to stock markets. They are sensitive to interest rates. So the lower interest rates go, the likelihood is premium bond prize draw will reduce also. Like I said, I've made a number of videos around premium bonds. This one links to one where my daughter and I, who both have £50,000 invested in premium bonds, fight it out on a monthly basis to see who wins the most. Now let's take a look at index-linked gilts. These are a special type of gilts where the income and the principal are adjusted in line with inflation. This makes them a really good hedge against rising prices. They are very safe, but because of that offer a lower return than other investments. They also are considered a bit more complex to understand than regular gilts. They are offered by the same brokers that will offer you standard gilts. They're normally subject to taxation on distributions, but they are capital gains tax exempt. Now, it's worth noting inflation uplift is tax-free. When we come to the correlation with the stock market, this is more complex. Correlation between index-linked gilts and the UK stock markets has been historically less consistent than conventional gilts and stocks. There have been periods of both positive and negative correlation, largely driven by inflation expectations and interest rate movements. During times of high inflation or stagflation, which is when you have high inflation and low growth, a negative correlation has been more likely. In periods of low and stable inflation or during deflationary scares, a positive or weak correlation has been observed. So let's take a look at our final investment vehicle, the money market funds. These are funds that invest in very short-term, low-risk debt instruments. An example of this is the Sterling Short-Term Money Market Fund by Vanguard. They're highly liquid, meaning you can access your money really easily. They aim to maintain a stable share price, making them a good place to park cash temporarily. Their returns are typically lower when compared to equity investments, for instance. However, they offer a safe haven for your cash with high liquidity. From a taxation perspective, they're normally subject to tax on capital gains, but also on distributions. And looking at the correlation, there's limited direct correlation with the stock market performance, but as interest rates drop, markets tend to perform better, but money market funds are generally linked to interest rates, so they drop. So that might infer a weak or negative correlation. I've made a whole video on money market funds. It goes over money market funds I invest in with Vanguard and Invest Engine, and you can see the link above if you're interested. Why don't we take a look at how each of the investments have performed over the last 10 years, 2 years, and 1 year. Again, this information is included in the download that's shown in the description below. You can see the performance here in this table. 10-year performance for instance, premium bonds has been low because historically interest rates were much lower. But now more recently, up until May 2024, the 1 year's performance was 4.4%. If we look at money market funds, for instance, low returns for 10 years, but more recently the money market fund returns have been much greater. Looking at bond funds though, you can see over 10 years a return have been between 2.5% and 3.5%. But a terrible period over 2 years because of market conditions. But more recently, returns have started to get a little bit better again. So let's wrap up. It's been a whistle-stop tour of how different bond-related and cash-related assets perform under various economic conditions. But remember, there's no one-size-fits-all answer to investing. The best strategy for you will depend on your individual circumstances, your risk tolerance, and your financial goals. This is certainly not financial advice, so I strongly recommend you speak to either a financial advisor or do your own research if you're not sure. And if you found this video useful, please like, subscribe if you haven't already, and click on the notification bell to be advised about the next video as it comes out. But more importantly, I'd be interested in your comments on what you're doing with bonds or cash-like assets within your portfolio. And with that, thank you for watching.